All right, Kimani, you want to kick us off?
Hi, thank you so much for joining us today. I'm Kimani. I'm the Meaningful Living Program Director here at TimeWise Financial, and we are extremely excited to present the History of the Markets and Psychology of Investing webinar that Matt has prepared for you all. So we have received some questions and some concerns from clients about the current market, and we do understand that while it is not the most beautiful looking thing, right now, we just want to reassure you that we are looking out for your best interest and for your future. And so if you have any questions during the presentation, please type them into the chat and Matt will do his very best to answer them at the end of the presentation. So Matt, you can go ahead and get started.
Awesome. Thank you, Kimani. So thank you so much, guys, for joining, and I hope everyone is doing well. Today, we wanted to take a moment to add some perspective to recent hiccups that have occurred so far this year. Now, we understand that so far this year, the market has struggled to find its footing, but this is not the first time we've experienced a down market, and certainly will not be the last. The reason we even felt the need to do this webinar is due to the current climate. You know, the world at times, thanks to aggressive news media, can seem a bit doom and gloom. But contrary to Athens natives' REM, it's not the end of the world as we know it. So the goal of today's webinar is to add some historical perspective to our current market situation, as well as point out the emotions that come to play and are often hard to navigate at times like this. We're going to show some data that will help to add long-term perspective in this short-term market downturn and help you be aware of the emotions that come with investing. Once aware, it can be a bit easier to practice mindfulness and not panic when things turn gray for a period. Now, managing emotions is the most important skill to practice for investors, and part of the reason you are wise for engaging the services of a financial advisor. This is because finance is 80% managing emotions and only 20% head knowledge, meaning that all of the schooling and education your team at TimeWise has completed is important, but pales in comparison to the importance of our team's ability to help you manage emotions. A good advisor helps you make money when the market is up, but a great advisor does just that, gives advice at times when you may be feeling worried or concerned about a particular issue. We are able to act as independent third parties to your financial picture and help at times like this when emotions may be running high. Lastly, you will see some slides with our educational partner logos on the bottom, which highlights the benefit of working with us. As we have access to so many fund companies, it ensures we are able to access the best options for you instead of being tied to one single company. So without further ado, let's jump right in. All right, we want to begin by taking a step back. It's been a tough 5 months, but in the grand scheme of things, this 5 months is just a blip on the radar and not the first time we have faced market turmoil. Just 2 years ago, we were facing some very scary times as the pandemic had just begun to spread throughout the US. There were no doubt traumatic times, but much like the many challenging times prior, we adapted and overcame, a trend we humans, especially here in the States, have proven to be especially good at. These Time magazine covers show some times in the past when media was fanning the flames and feeding hysteria. The two eventually passed. Now, many have also, due to media coverage, been very worried about government spending. While robust and arguably necessary to a certain degree during the pandemic, this is not the first time media outlets have fanned the flames of concern regarding government debt. Something they never talk about is the other side of the balance sheet. You know, how much countries owe to us. It is important to note that thanks to the internet, as well as, what some would call identity politics, is this sentiment today where the only thing that matters about who you are, the only important aspect is what you believe politically. That's an idea we believe at TimeWise to be false, but according to the internet and media, that's all that matters today. And you can see that media coverage has drastically changed. And there once was a time when Walter Cronkite would hop on CBS Evening News for just 30 minutes and simply speak the facts of the day's happenings. This has since been replaced by a barrage of media coverage to include 24-hour political opinion pieces, as well as 24/7 engagement via the internet and social media. We are what we eat, per se. And it's not hard to see why the nation may seem more divided at times when you step back and look at what many consume. The refreshing thing is, though, that as emotionally charged as the news can be, it has very little impact on the market over the long run. And using the news to base your investment decisions is a verifiably terrible idea. Though don't just trust me, let's put some data to my words. Oh. All right, so this slide just goes to show the resilience of the stock market, going all the way back to 1936. This is actually the S&P 500. And it goes from 1936 until today. And you can see, along the way, there's been some major events. We can see multiple conflicts, many much worse than the conflict currently going on in Ukraine, as well as other major events, many much more concerning at the time. That's the importance, at the time, than the world we live in today. The point of this slide, though, is to show the market has shaken off much greater challenges than those we face today. And what you'll notice is over the long run, it trends, in an upward direction. So this next slide highlights, the good times versus the bad. And so the orange bars along the history of the market from 1926 are bull markets. That's good times and the economy's growing, the stock market's going up. The blue times are, some of those gray times, the bear markets. And first we want to point out, look how much orange there is relative to the blue. Over the history of the market, the average bull market lasted 6 years, whereas the average, bad market or bear market only lasted around 16 months. So, the good times are much more prevalent and last way longer than bad times, and that should give you some hope. Even though we're in a pullback at the moment, bad times are usually way shorter than those good times. Now, this slide adds some perspective. I really like this slide. And so these blue bars, these are calendar years, December to December. And you can see, 2008, Great Recession. For the year, the calendar year 2008, the market finished down 37%. Another great example, 2020, roller coaster of a year. But the market finished from December to December up 21%. Now these orange boxes here across the bottom, these are the max pullbacks, or the most the market was down during that given year. And you can see, obviously during the Great Recession, the market dropped almost 50% at one point. That's indicated in 2008. But along the way, on many of these positive years, the market pulled back as much as 21%, 33%, 20%, even in some of these positive years. But overwhelmingly in each of these calendar years, even though throughout the year, over the short run, there was these big pullbacks, the market ended up finishing positively. Now, this slide actually highlights the value of a long-term perspective. And so I want to focus on the green bars. The blue bars, that's stocks. The brown bars, that's bonds. The green bars is a balanced portfolio, very similar to what we recommend for most of our clients. And what we're looking at here is what they call rolling returns. And all that means is they're looking all the way back to 1976. And over here on the 1 year side, on the left side of your screen, they're saying, hey, what was on any 1 year period during that, almost 50-year period, what was the most you could have been up or the most you could have been down? And so on a short-term time horizon, like we see on the 1 year side, you could have been in a balanced portfolio up as much as 45% or down as much as 27%. Arguably somewhat of a roller coaster. But let's take a step back. Let's, as we're encouraging you guys to do, broaden our perspective and look over a longer time horizon. Let's say 5 years, continuing to look at the green bar. You can see a balanced portfolio over any of those 5 year rolling periods. never lost money. It was either flat or positive as much as 26%. And then lastly, let's take a look on the right-hand side of the screen on the 20-year. And this is why we as investment professionals can confidently say, hey, we can over the long run expect a positive return of anywhere, depending on your risk tolerance, from 4 to 8%, depending on what you're invested in. And that's because over the long run, the market generates positive returns on any single one of those 20-year periods. You got to think over 20 years, if you start in 1999, you're including the dot-com bubble, the Great Recession, and depending on your exact start date, maybe even the pandemic. And still, even the worst of those 20 years, your worst outcome was an average return each year of 4%, and your best was 14%. You never were even flat or lost money. So over the long run, as opposed to looking over the short run, you can see everything reverts to the mean or washes out. All right, so this slide here goes to show, when your average investor, think of the people, they're kind of DIY, or they stay out of, they're not very involved in their investments or don't engage the services of an advisor. They tend to only get involved in their investing or make decisions in regards to their investments when things get scary. And so what this slide shows is the blue line is the market. You can see along the way over the last 15 or so years, they've indicated some bad market returns when things really got ugly. The red line is actually Google Trends search data. And so across the country, they saw how many people are searching for CNBC to check up on what's going on in the market. And what you see is when times get scary, those search results, people all of a sudden, they want to see what's going on in the market. They want to stay up to date. They want to get that negative news coverage in front of them. And it leads to bad decision making. Whereas you guys, as long as your clients engaging the services of a financial advisor, we're staying on top of the happenings in the news at the good times and the bad times. And that perspective and that independent third-party status prevents us from making knee-jerk decisions and helps us talk you out of doing the same. So speaking of knee-jerk decisions, let's see what happens to the average investor. So we took a look at a panicky investor. And so for the sake of this story, let's call her Nervous Nellie. Now, Nellie works as an accountant, and she knows a thing or two about finance, and therefore she's decided she's going to manage her own assets. She likes to live life on the wild side, and she even wears a life jacket when she drives in case she ever were to wreck into a creek that she drives over each day on the way to work. Since she considers herself to be a wild lady, she buys a portfolio recommended by her favorite evening television host, Jim Cramer, who says, just buy index funds. So she does just that and only has stock index funds. Think the S&P 500 or the NASDAQ. Now, her friends at work, they say, our advisor recommends diversifying, but she trusts Jim Cramer, a man who legally can no longer trade on his own behalf due to fraud. I encourage you to look that up. Though each time the market went down 30%, Nervous Nellie, she started to get really nervous. And she said, I'm getting out. I'm hitting the panic button. I'm selling out, and I'm not getting back in until things return to normal. Now, you can imagine how this probably really affected her returns, but let's see how she ended up doing. So Nervous Nellie, here's the red line. And, her peers, even she had all stocks. So her peers who had all stocks who just stayed the course are this dark blue line. And since they didn't panic, over this almost 50-year period or 60-year period, they ended up with $5 million. Whereas Nervous Nellie, she only had about 550 grand in her account. And even her friends, that they don't like a roller coaster ride. They like engaging in the services of a diversified portfolio. They ended up with about $2 million more than Nellie at the end of it all. And this just goes to show, even though in short-term periods, things can get really scary, the value of staying the course. So this is a quote I saw before we move on. It just said, every recession and bear market of the past was ultimately followed by an economic expansion and new all-time high in the future. So if you think back, all the way back to, pre-Great Depression, every bear market has seen all-time highs followed after it. So we've covered the history of the markets, but we also want to talk about the emotions that you may experience as, investors. And so I want to start off with this quote from Warren Buffett. Obviously a seasoned investor, arguably, at least during all of our lifetimes, one of the most successful. And he said, we don't have to be smarter than the rest. We have to be more disciplined than the rest. And we just showed you that with Nervous Nellie. She worked in accounting, knew a thing or two about finance, but she lacks that emotional discipline, which can be very hard to practice. And so we wanted to give you an idea first, before we talk about the emotions you experience, of the roller coaster ride that we realize is very present, over the course of a market cycle. And so this goes to show the S&P 500 on the left and a diversified portfolio on the right. And so this is going all the way back to the year 2000, so over 21 years. And you can see over here on the right, this is the emotions that we hear from the clients along the way. So dot-com bubble hits early 2000, and September 11th hits soon thereafter. And the S&P is down 40%. That diversified portfolio does its job. And that investor is only down around 15, 16%. But they're still just pent up and angry and feeling a whole slew of emotions because they lost money. They feel, like, why didn't I think to do something before this occurred? Now, the next period, 2003 to 2007, now they've got a whole new set of emotions, because this was a period where a diversified portfolio, having exposure to some international stocks, some bonds, a little bit of everything, really paid off. And even though the S&P was up 83%, a diversified portfolio with less risk actually won over that 4-year period. And that investor's feeling really happy. They're feeling really smart for being in the diversified portfolio. Now, 08, obviously, that same emotion that happened back in the early 2000s of, hey, even though I didn't lose as much as the S&P, I still lost money. We'll move on. And after the Great Recession, they might be feeling like, hey, the S&P was up a ton, and I only made a measly 220%. I didn't make as much. What are you guys doing over there in that diversified portfolio? If the S&P's doing that. But the point of this is, if when we come down to the very bottom and we took a step back, we look over the long run. Over that 21-year period, the diversified portfolio actually just barely beat the S&P 500 and had way less of a roller coaster. So that obviously is factually proven, but we don't want to discount the fact that we realize the emotions that you're going through during these good and bad times. And so we want to, give you an opportunity to put a name to these emotions, be aware of these emotions. And so when you encounter them now or in the future, you can actively try to manage those and be mindful and hopefully help reduce your panic. So the first emotion that is very prevalent, in investing and elsewhere, is what psychologists call confirmation bias. And all this is, I love this quote from Muhammad Ali. He says, I don't always know what I'm talking about, but I know I'm right. And so people have this innate ability to only seek out opinions that agree with theirs. So let me give you an example. You're really worried about the market. Things are popping off in Ukraine. Interest rates are going up. If there's an article, from some news outlet that says, hey, things aren't actually that bad. Interest rates going up is a good thing because it's going to help fight inflation, relative, as opposed to an article that, confirms your opinion, says, yeah, everything is terrible. You're going to be much more likely to engage that negative opinion because it aligns with your beliefs. So we encourage you guys, whether it be, in any aspect of your life, if you do sense this confirmation bias creeping up, at times it's good to engage, maybe some alternative resources, try to get an outside opinion, and it can really help calm the nerves. It's factually proven. Another key bias, that psychologists find that comes to play in the behaviors of investing is recency bias. And I love this quote from Warren Buffett. He says, what we learn from history is that people don't learn from history. When investors get either too fearful or too greedy, they sometimes hide behind the notion that this time is different, and usually they regret it. And so all this means is when something's going on, let's say Russia invades Ukraine, it's very easy for it to seem like the sky is falling, and you're living there in the moment. But we tend to so quickly forget about all the other, crazy issues and current events that we navigated throughout the past that were verifiably much more concerning at the time. We showed you that chart of the S&P 500 where obviously World War II was a much bigger issue in terms of loss of life and everything at the time than what we're experiencing now. But you're more worried today because you're living in the moment and lacking that perspective about what's going on today. So we encourage you, hey, before you allow that worry to take over, take a step back. Think back to all the other things, 2020, 2008, 2001, that the market is shaken off. And how much more concerning, if you distance yourself from that hysteria news coverage, is what you're going through right now. Additionally, we have herding bias. So herding bias just means we are innately trained from childhood to not, break away from the herd. If the herd ends up jumping off a cliff, we'll be right there with them. And you see a lot of this with average investors. The herd starts to sell. And without an advisor on their side to help them manage those emotions, they follow suit. Or the herd starts to buy. Bitcoin, Netflix stock, over the last 2 years, you could have easily said, I just want to buy that kind of stuff. But you can fall victim to the herd. And in both cases, there's many examples of people selling at the exact wrong time or buying stocks like Netflix that are now down 70% year to date. And so it's important to stay the course, use the advice that we offer, and do not fall victim to the herd. Now, this last behavior that you're going to experience as an investor, it sounds really fancy, but it's not. It's called myopic loss aversion. And all it indicates is, hey, we are much more sensitive to pain than we are to pleasure. It feels good to make money. It really hurts, though, to lose money. And psychologists have been able to prove that, you feel 2 times the emotions for pain than you do for the equal amount of pleasure. So put yourself in the shoes of someone going through this emotional roller coaster. Imagine, you saved up $500. You're heading up to Cherokee to go play your hand at blackjack. And, within 4 hands, you lost that $500. You're going to be beating yourself up. The Waffle House on the way back is not going to taste very good. You're going to feel like, I'm an idiot. What was I thinking? Whereas on the flip side, let's say you double that $500, you turn it into $1,000. That's going to feel great. You're going to help pay for the gas to get you up there, maybe cover your hotel room, but you're not going to feel nearly the amount of emotion as you did in the other scenario. So we've painted the history of the markets. We've talked about some of the emotions you can expect to experience, but we also wanted to wrap up with some silver linings. There is some positives going on at the moment. And so, yes, interest rates are going up, but what does that mean? This is going to help stifle inflation. Obviously, 8.5% inflation isn't sustainable, and already we're seeing inflation starting to drop just last month, thanks to these interest rates. This is what we need. Additionally, for the past 5 years, especially conservative investors who had bonds in their portfolio, those bonds were kind of just asleep. Interest rates were really low, and it meant your savings accounts, your CDs, any of these interest-bearing investments weren't paying you too much. But now that interest rates are going up, these are going to start to be a key part of the portfolio again. We might be able to see 5 or 6% out of a bond fund, something we hadn't seen in quite some time. And that all goes to help your returns. So it might be a little bit of a bumpy road to get to the destination, but over the long run, we think this is going to be a good thing. And additionally, this is another silver lining I wanted to point out. You know, everybody's saying everything is going to kaputs. Well, unemployment's back to all-time lows. This chart on the left here is the unemployment rate. And you can see up here, it's at 3.6%. And a lot of people would say, hey, well, that's great, but a lot of people are still sitting at home. They're just not included in this data. But I want to point out also, you know, this is what they call labor force participation. So they take a look at all the people 25 to 54 years old. That's the meat and potatoes of the labor force in this country. And they say, how many of those people are actively working? And what you see is we're right back to pre-pandemic levels. You know, 82.5% of those people in that age range are actively working at the moment. So the argument, hey, people are just sitting at home doesn't hold any water. And why this is a silver lining is because low unemployment, you know, when people are getting checks, they're spending money. That's good for economic activity. Lastly, I wanted to point out what they call the Consumer Confidence Index. And all this is an indication of, hey, are people feeling good or bad about what's going to happen next? And so you can see over the long run, you know, it's bounced all over the place. But what's really interesting is that when times are really good, when consumer confidence is high, the next 12 months, that's these numbers right here, aren't all that great in the stock market. You know, people get a little over exuberant. They're probably overestimating how good things are going to be. But when things are gray and consumers are really worried, oh my gosh, things are, you know, the sky is falling. The next 12 months are actually really, really positive for economic returns. And if you look right now, at the end of March, we're kind of at a low point. So if history holds any weight, you know, according to historical data, low consumer confidence means, hey, people are overreacting. The herd, it jumped off the cliff, but the next 12 months should not be all that too bad. So in closing, you know, the news has been just barraging us with negative coverage. We get that, but not all the news is bad. And so we wanted to wrap up with just a positive news story, something so rare these days, but we thought it'd be a good addition to the presentation. So here we go.
Time for a little weekend morning boost. Joe is back with that.
Yes, this one comes with tissues or hanky, whichever you
got
prefer. It's a bit of a tearjerker. It all starts when 12-year-old Ariana steps up on the altar when her mom is about to get married. Watch what happens after she hands an envelope to the groom.
I waited 2,555 days for this moment. Frank, you're my dad.
Ariana said that is the number of days she has felt like Frank Tyson was her father. Mom Tia said everyone at the wedding knew the request was coming except one person, Frank. Helps explain his choked up reaction. The family is now waiting on a court date to make it official. I call that a proposal within a wedding.
Oh, I love that. That is.
All right, so obviously the news can be very negative, but we could use some more stories like that. And I encourage you guys to try to surround yourself with some positive media, especially at trying times like this. But without further ado, we'll open it up for some questions.
Thank you so much, Matt. Thank you for sharing that and sharing perspective for all of our clients. And so we hope that this did serve as a reassurance for you all that not only are we looking out for your best interest, but that we are always available to answer any questions that you may have. We are definitely on your side. And so let's see, let me check in the chat really quickly. It looks like we don't have any questions from anyone in the chat. So that means thank you so much that you did an amazing job, Matt. I just wanted, before we end, are there a couple tips that you are able to give to the clients about, you know, there are clients, they have eyes, they're still a little bit scared. What are a couple tips that you would give them of, you know, some things that, practical tips of some things that they can do that will help them?
Yeah, I think obviously you have that mindfulness of, hey, when times get concerning, you are going to experience an onslaught of emotions, but maybe taking some time to break away from the media. You know, we've all had times in our life where we were so busy or wound up with a life event that we weren't able to watch the news for a few days. And the world kept spinning. You know, the world didn't stop because we missed out on the news story of that day. And so sometimes just taking a little break, you know, maybe whatever your happy place is, if that's in a book or by the pool, and breaking away from all the negativity can be a great thing. Also trying to engage positive media, you know, that's really a challenge today. I do realize that, but you want to stay informed. I definitely understand that, but, you know, maybe steer clear, especially at times like this, from all the opinion pieces and try to just focus on the facts. Otherwise, you know, just realize, hey, these emotions are real. And now you're armed with the information to at least know, hey, this is what I'm experiencing. And utilize us. Lean on you. You have an advisor. Utilize your advisor to help you navigate these times when you're feeling tough. Because if you're feeling worried or feeling concerned, we can't really help you out unless we know about it. So please reach out.
Thank you, Matt. And it looks like we did receive a question. Is it, in your opinion, a bad time to sell or buy real estate?
Awesome. Yeah, that's a great question. So obviously, I don't work at BlackRock's real estate fund or anything, but in my personal opinion, yes, interest rates are going up. What that means is, hey, you got a bunch of people in the last 2 years who bought houses at 2 and 3%. So why would they go pursue a transaction if now they're going to have to pay 5 or 5.5%? So what they call the tenure of home ownership, or the length someone stays in their home, is about to start to tick up a little bit. But here in Georgia, where most of our clients reside, I think we got some additional factors at play. We've seen a great migration in this country, and a lot of people from all over the country are moving to the 8th largest economy in the country, Atlanta, Georgia. And that helps support, you know, Georgia real estate prices. So while interest rates are going to help do what they need to do and soften some of this over exuberance or white hotness in the overall real estate market, I don't think we can expect some major pullback or anything like that. The guidelines to getting approved for mortgages and, you know, the overall real estate market is in a way healthier and heavier regulated place than it was, you know, the last time we saw real estate pullback.
Thank you so much. So this does end our time. We do want to, out of respect for every single one of you, we are going to end it right here. But thank you so much for joining us. We just want to remind you that you guys are in the best position because you have hired a financial advisor, financial planners to stay on top of all of the news for you. So if you have any questions or any concerns, you can always reach out to us. We are here for you. Thank you, Matt, for presenting such an amazing piece, an amazing webinar for us, and have a great rest of your day. Bye.